Hello guys, I am going to record lectures for finance static notes, and today I will be covering introduction to Indian financial system, time value of money and bonds. These three chapters from the RBI GRADE B syllabus for finance. Like this is more for my revision and memorization process rather than for teaching anyone. So basically, Indian financial system has three basic components. First is financial institution, financial market, financial market, and others. Financial institutions have banks, NBFCs, and insurance companies, and mutual funds. Financial markets have stock exchanges, bonds, and money markets, and others include regulatory bodies and other government policies. So, moving on, the basic characteristics of financial system are they act as an intermediary between the uh, like those who require fund and those who are willing to provide fund. It helps in capital formation and hence also in the growth of nation. It helps in diversification of investment portfolio, and as uh, investment is if investment is more diversified, obviously the risk management will be lesser, and it also helps providing liquidity to our assets. It encourages innovation and also facilitates different payment mechanisms. These are the basic characteristics. Moving on, financial system also creates a kind of transparency between the buyer and seller and also ensures a kind of financial stability. Now, let's look into the history of financial market. First Bank of Hindustan was established in 1770. Then Bombay Stock Exchange was formed in 1875. Then Reserve Bank of India in 1935. Then SEBI Securities Exchange Board of India in 1988. Then liberalization of Indian economy happened in 1990s. Then National Stock Exchange was formed in 1992. This Indian financial system has basically eight components: bond market, stock or equity market, forex market, debt or money market, primary and secondary market, Indian banking sector, oil India financial institutions, and non-banking system. In the subsequent chapters, we will be reading about like each one of this in detail. But today I will be only covering the bond market. But before that, we have to study the chapter, the time value of money. So the basic chapter is over. These were all the important parts in that. Now, in time value of money, basically, what does time value of money mean? It means the value of and specific amount of money, how much it will appreciate or depreciate with given time. So uh, it can also depend on compounding. Compounding means at the rate at which it will double or like triple. Like basically, if you have X amount of money and you are getting R interest in that, like after how much time you will get that R interest paid on that X amount of money. It can be 1 year or 2 year or 3 year or lesser than 1 year. This is known as compounding. This can be of two types: annual compounding or frequent compounding. Annual compounding means if the interest is paid after 1 year, and frequent compounding will be like for any time period other than 1 year. It can be semi-annual, which will be for 6 months. It can be quarterly, which will be for 3 months. It can be monthly, which will for each 1 month, and it can be continuous also. Continuous meaning it can be for any number of days, and it will be compounded with the time. Like every day, it will be compounded. For continuous compounding, it will vary with the power of exponent. Uh, like uh, 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 Return will be equal to principal into e to the power rate of interest into time. And for frequent compounding, for semi-annual, quarterly, and monthly, the formula will be return will be equal to principal into 1 plus rate of interest divided by number of times it will be compounded in a year to the power time into number of times it will be compounded in a year. Okay. Now let's look into annuity. Annuity is any like set of series of regular payment or receipt. It can be any kind of subscription, SIP or salary or anything. Annuity is basically of two types: ordinary annuity and annuity due. Annuity no, ordinary annuity basically means like when the payment is done at the beginning of each period, and annuity due is when the payment is done at the end of each period. No, sorry, I just said the opposite. Ordinary annuity is when the payment is done at the end of each period, which is usually in the case of our FDs or etc. And annuity due is when it is done at the beginning of each period. Now, what is okay? There are three rules for calculating our in how much time our money will double or triple or quadruple for a specific rate of interest. So, rule of 72 is known as the rule which will tell us in how much time a specific amount of money will double with a constant rate of interest. When we divide 72 by that rate of the interest, we get that number of days. And rule of 114 tells us in how much time it will triple. Rule of 144 tells in how much time it will quadruple. In each of these cases, we need to divide it by the rate of interest and it will give us the time. Now, what is effective interest rate or annual equivalent rate or annual percentage yield? This basically means the interest rate for um, after a specific time, like maybe you like consider for semi-annual compounding, you are having interest rate of 6%. So in a year, two times you will be having compounding of 6%. Now uh, for the whole annual interest rate, it won't be 6%. It will be definitely greater than 6%. So to calculate that, this is method: effective interest rate or annual equivalent rate or annual percentage yield. This is the formula is EIR equal to 1 plus rate of interest divided by, I think this is number of times it is compounded to the power number of times it is compounded minus 1. Now this chapter is also done. It is a very basic small chapter. Now let's move on to the main chapter, which is bonds. Now, what are bonds? Bonds are basically a kind of debt instruments given by companies or governments. Basically, where companies or governments borrows funds from others uh, by signing them a bond, like giving them a bond, which tells us at the maturity period of the bond or the value which the bondholder will get after like at the end of maturity period, the bondholder will get. Basically, the bondholder lends some amount of money to corporates or governments, and so that is all. Like this is the process only. Now there are, I think, 18 kinds of bonds. Yeah, there are 18 kinds of bonds. Um, First one will be government bonds. These are issued by central government, and these are a bit safer in nature, uh, and also they give a little bit lower return. These are of three kinds. Um, Firstly, central government can issue bonds, government bonds in our Indian currency as well as in foreign currency. For Indian currency, these are of three kinds like bills, notes, and bonds. Bills are the bonds which will be issued for less than 1 year. Notes are the bonds which are issued for 1 to 10 years, and bonds are the bonds which are issued for more than 10 years. Now, these are all are issued in same currency. Also, there are muni bonds. These are issued by municipal corporation, but also again government bonds. Now, the central government also issues bonds in foreign currency, and these are known as sovereign bonds. Okay. Next are corporate bonds. These are issued by corporate organizations, and these are riskier than government bonds, and hence they also give higher rate of return. The zero coupon bonds or discount bonds. These are the bonds, they do not make interest payment at regular intervals, and also these are sold at a lower amount than the face value at a discounted rate. Like consider your like the face value of the bond is 100 and it is sold at 70. So, but at maturity, no regular interest payment is done throughout the whole maturity period. At maturity, the face value is given back to the bondholder, which is 100. So basically, the difference between the face value on and the discounted value, 100 minus 70, 30, is the profit for the bondholder. So that is why, because of this discount, this is called discount bond, and since no interest payment are made, these are called zero coupon bonds, as no coupon payments are made. Now, perpetual bonds or perp bonds, these are bonds which don't have any fixed maturity and they go on forever, and they are like issued in case of very crisis or like any emergency. This was issued by war, like UK government, for known as war bonds. These are going on till date, like the war bond by UK government. Next would be senior and junior bonds. Like in case the company defaults, at the time of the liquidity, this is basically the priority level on which the bonds are repaid. Senior bonds are repaid earlier than junior bonds, and that's all. Fixed interest rate bonds. These are the bonds having fixed interest rate throughout their maturity, like 6%, like any fixed rate. Uh, Floating interest rate bond or floaters. These are the bonds who do not have fixed interest rate, and a benchmark is considered. Like let us consider your benchmark is repo rate, and the bond issuer tells that they will give you the interest payment of anything of repo rate plus 2%. No, so whatever the repo rate will be at the time of your maturity plus 2%, that interest payment the bond issuer will pay you. Now this addition of 2% is known as spread. Now this 2% here is added to the benchmark. Now let's come. Inverse floaters are the bonds which have in which the spread, meaning the 2% is subtracted from the benchmark. Like either 2% is subtracted from the benchmark, or the like benchmark is subtracted from the spread. Like here 4% is subtracted from, like here repo rate is subtracted from 4%. We can also subtract 2% from repo rate. So repo rate minus 2% can also be your like inverse floater rate. So this is right. Junk bonds, these are basically bonds having higher risk of default, and these are issued by financially struggling companies. Callable or redeemable bonds, these bonds are the bonds which can be called by the bond issuer before the maturity, and it can be called by paying a certain amount of premium uh, along with the existing um, amount which needs to be paid at maturity. Puttable bonds are the bonds which they are like the bondholder can put that bond before the maturity. So that is all. Convertible, non-convertible bond, meaning the bonds they can be either converted to equity shares at the end of maturity period or not. Like equity shares of the company itself, not of any other company. Serial or term bonds, meaning like serial bonds are I think for yeah, for shorter period of time, and term bonds are for very long period of time. Green bonds are basically bonds which are issued for any climate related purpose, like um, for any like climate related purpose. If the funds are being gathered, then they will be called green bonds. This was issued by RBI, known as Sovereign Green Bonds (SGB), to finance public sector projects that help in reducing the carbon intensity of the economy. Blue bonds are the bonds which were issued for water management and marine sector projects. Yellow bonds, they are the like bonds issued for like solar energy purposes. Elephant bonds are for infrastructure projects, and okay, so these were all for that reason. Now, registered bonds and bearer bonds. Registered bonds are the bonds like the bond issuer has all the like some basic information of the bondholder, and all the payments are done directly to the bondholder, uh, like whoever the bond is registered to. The bearer bonds means the whoever the bond is carrying at that time is bearing at that time gets all the payments. Doesn't matter who's like, yeah, anyone can get, like, if you have this bond you can claim this amount, that's it. In registered bond you cannot claim this amount even if you have the bond in physical form, or however, um, obviously registered bonds are more safe also. Now, foreign bonds are raised in India by foreign companies, in the Indian investment market for the Indian investor. That's it. So these were the types of bonds. I think, yeah, not much is left. Okay, this much only. So yield is basically the coupon amount of bond divided by the current market price of that bond into 100. Okay, so this is the yield. Now, yield to maturity, Y to M. Yield to maturity actually tells us about the, like, uh, yield which we will be having if we hold the, like, how much rate of return we will get if we hold the bond till the maturity time. This is yield to maturity, and it takes two important assumptions, like this is very important. uh, uh, Two assumptions into consideration. One is investor will hold the bond till maturity, that is basic. Second is coupon payments received will be reinvestment in the same interest rate. Okay, so, like, whatever coupon payments you are receiving, you will reinvest it at the same interest rate in that bond itself. Okay. And the formula for this is written here. Okay. Now there are three, I think, relationship between, like, interest rate of banks, price of bond, and yield. So, okay, these are the three relationships. First is price of bond is inversely related to interest rate of banks. Now, how this happens is, if the consider like the interest rate of bank is going higher. So if bank is providing higher interest rate, then people will be more interested in bank. Then the price of, like, they won't be interested in bonds anymore. So the price of bond will start to fall. So as interest rate goes higher, mm, price of bonds goes lower, and vice versa. So that's why it is inversely related. Same, price of bond is inversely related to yield. Now, what this means is we can directly see it from here. Yield is equal to coupon amount by current market price. So market price is inversely related to yield. So this is just written in language here, and yields are directly related to interest rate. So this is basically like the combination of these two. If price of bonds are inversely related to interest rate of banks, and price of bonds are also inversely related to yield, then of course yields are directly related to interest rate of banks. So that is all. These are three relations. Now, okay, let us consider bond price. Now, bond price is the basically the amount an investor is ready to pay for a specific bond, and that can be either higher, lower, or at the same price. If the investor is willing to pay higher for that bond, then it is called premium price. If they are only willing to pay lower, then it is called discount price. And if they are willing to pay the same amount, then it is called par price. Now, bonds are based on types of coupon payments. There are two kinds of coupon payments: zero and no coupon payments. Like for discount bonds, which usually happens, no coupon payment is there, and the whole price is paid at the maturity. And perpetual bonds, which the coupon payment is throughout the whole journey, and there is no maturity. So that is all. Like, this is the first the initial investment, how much it was done, divided by rate of discount. This amount is given, like, now forever, which happens for the per bond. Now also, Gordon Malkiel, he gave properties of bonds. He gave five properties of bonds. These are very important. Um, like, I think we just need to mark this up. You can also understand it, but there's not much to understand. So basically, like this was kind of a study, I think. So the relationship between market interest rate and bond value is inverse. So which we read about here also. Also, the relation between interest rate and bond price or value is inverse, but at the same time, it is not also a straight line. It is convex. Like I think it is like this. Yeah, it is like this. It will fall down in a convex manner. Also, the longer the time to maturity, the greater change in its value to a given change in interest, which is obviously like for a long term bond, the change in value will be higher than for the short term bond. But like no, but this is again written here that convexity of the relation between interest rate and bond prices increases as maturity price increases. It's like as maturity increases, this mm, like how can I draw it? I don't know. I think yeah. Now as like okay, my drawing is not good. Obviously now this is for low maturity period. This convexity will increase for higher maturity period. I think this sort of curve will be there. Yeah, that is what I'm understanding. So yeah, convexity of relation will increase. Okay, let me just check it. Okay, yes, I was right. So yeah, let's erase this. How to erase it? Here I have eraser somewhere. Yeah. Oh, how to erase bro? Why is this not getting erased? Okay, yeah. So yeah. So where were we? Yeah. So convexity of relation between the interest rate and bond prices increases as maturity increases. Also, prices of high coupon bonds are less sensitive to changes in interest as compared to low coupon bonds. It is obvious because the coupon payments are higher, so they kind of like nullify the impact of change in interest rate. So yeah. Now, yield to call ratio. This is basically the yield to call ratio tells us about the rate of return if we call a bond before its maturity period. So, like there, the yield to maturity tells us the rate of return uh, after the maturity, like at the maturity period, and yield to call tells us the before the maturity period for any specific timeline we want. Then it tells us that. Now, holding period return, like this is for calling the bond. Holding period return is means the like tells us the maturity. Now, tells us the rate of return. Uh, if we hold the bond, like if we don't hold the bond till the maturity, if we like put the bond before the maturity, this is the value it tells us. And annualized HPR is basically the holding period return is also not for like uh, I think it is, yeah, it is not for till maturity. It is for a specified time. And now annualized HPR actually tells us the annual value of that holding period return so that we can compare different kind of investment options, like whatever investment options we have there. So yeah, that is what it tells us. Like this is for comparing different investment options. Now, these are the basic like risk associated with bonds, like credit risk. The issuer might not want to pay you back. Interest rate risk, like the interest rate may fall in case it will be like bad in case of floating interest rate bond. Reinvestment risk, like whatever uh, m- coupon payments you are receiving, you might not be able to reinvest them at the desired interest rate. Liquidity risk, the issuer might go bankrupt or any case of liquidity may arise and you won't be able to like get your money back. call risk. The issuer might call the bond before the end of maturity period, and it can occur, some losses can occur. Um, yeah, that is all. Balloon repayment loan. Balloon repayment loan is basically the bond in which the interest is paid throughout the life of the bond, but the entire principal is paid at the end, like at the maturity. So that amortizing fund is the bond in which the principal is repaid along with the interest throughout the maturity period of the bond. So these are just opposite. Now, sinking funds are basically a kind of funds in which firms make annual contributions to have enough funds to meet a large requirement of liability in future. And mortgage bonds are basically like funds taken for like home loans. And equipment trust bonds are like the loans, but they are taken for movable objects or equipments. That is all. So yeah, this is done. Okay. Yeah, this is done. Tomorrow I think I will do derivative and equity market. And I think I don't know how much I will be able to do. Forex market I definitely can't do. Oh, forex market this much. Okay. I think I will do derivative market and equity market. Yeah. Uh, this is basic of derivative, equity market. Okay, let's see how much we can do tomorrow. Now, today I was able to do perspective. I will do it now. Wait, man, what is this? Okay, yeah. So I was able to do revision for today. Perspective I will be doing now. Like I just watched the video. Okay, let's write tomorrow's to-do list. Okay. Um. Where is it? Oh, where, wait. It's found. Yeah. To-do list. Okay. So tomorrow I will do finance chapters. Um. Current affairs. To date. And also bonds. Two papers. Since I don't have class tomorrow, so I will be doing a bit more. Yeah, that is all. I haven't actually corrected, done this till now. Management static, I don't feel like doing it anymore right now. I will do it after finance. I just can't handle it. So yeah, that is all. Thank you.